Want to know the easiest way to predict which stocks are about to explode? Follow the money of people who literally write the laws that determine which companies will succeed. I'm talking about members of Congress, the people who sit on committees that regulate industries, approve budgets, and know about policy changes months before the public does. These aren't ordinary investors. These are people with access to information that you and I will never see. And when they start buying a stock, you better believe they know something. Today, I'm breaking down 5 stocks that the most active congressional investors are buying right now for 2026. And I'm going to show you exactly why these picks matter, what the numbers actually say, and whether you should follow them into these positions. Because here's the truth. Congressional stock trading is controversial for a reason. These people have an unfair advantage. They know about legislation before it's announced. They know about regulatory changes before they're implemented. They know about government contracts before they're awarded. And they're making fortunes from that knowledge, while the rest of us are left guessing. So today, we're going to reverse engineer their trades and figure out what they know that we don't. Let me start by introducing you to the most prolific stock trader in all of Congress. And no, it's not Nancy Pelosi, though we'll get to her later. The #1 most active trader in Congress is Josh Gottheimer. This guy is a legend when it comes to timing. He sold Silicon Valley Bank stock on March 9th, 2023. The bank collapsed on March 10th. 1 day later. 1 day later. Now, either this man has the greatest crystal ball in financial history, or he knew something that the rest of us didn't. And conveniently, he sits on the House Financial Services Committee, the committee that oversees banking regulation. Gottheimer has made over 2,600 trades. His estimated net worth is $46 million, though that number is probably significantly higher because of how congressional financial disclosures work. See, when members of Congress file their financial disclosures, they don't have to list exact amounts. They list ranges, 1 to 5 million, 5 to 10 million, 10 to 25 million. So when someone calculates their net worth, they're averaging those ranges. But if you're making 2,600 trades, you're probably on the high end of every range, not the average. My guess? Gottheimer is worth well over $100 million. And right now, he's buying Tesla, aggressively. Now, I've been vocal about my opinion on Tesla. I think it's wildly overvalued. I think people treat it like a tech company when it's actually a car company with a software division that hasn't been fully monetized yet. But Gottheimer is buying, so let's figure out why. Tesla is currently trading around $165 per share. It hit an all-time high of $415 back in November of 2021 and has been in a downward trend ever since. The company sells for 6.5 times price to sales. For context, the average car company sells for 0.5 to 1 times sales. Even if you want to argue that Tesla has a software component, let's compare it to Microsoft. Microsoft, a pure software company with 70% gross margins, sells for about 6 to 9 times sales. Tesla has 17.8% gross margins. That's a car company margin, not a software company margin. So why is it valued like a tech company? Because of the story, because of Elon Musk, because of the promise of full self-driving, robotaxis, and AI integration. But promises don't equal profits, and the numbers don't support the valuation. When I run Tesla through my stock analyzer tool with aggressive assumptions, 7 to 12% revenue growth, profit margins of 10 to 20%, which assumes significant software monetization, and a PE ratio of 15 to 25, I get a fair value range of $56 on the low end to $347 on the high end, with a middle estimate of $150. Tesla is currently trading at $165. So according to my analysis, it's slightly overvalued even with aggressive growth assumptions. But Gottheimer is buying. Why? Maybe he knows something about upcoming federal policy that will benefit electric vehicles. Maybe he knows about tax credits or infrastructure spending that will boost Tesla's sales. Or maybe he's just following the hype like everyone else. But given his track record, I wouldn't bet against him. Let me move to stock number 2, PayPal, being bought by Tommy Tuberville. Now, Tommy is a character. In 2021, he violated the Stock Act by failing to disclose over a dozen trades on time. When asked about banning congressional stock trading, he said it would be ridiculous and would disincentivize people from running for Congress. He actually said, they might as well start sending robots up here. Tommy, let me respond to that directly. Shut up. You don't go into Congress to trade stocks. You go into Congress to serve the country. If you want to trade stocks, become a hedge fund manager. Put your investments in a blind trust. Have someone else manage them. Buy low-cost index funds and call it a day. There is zero reason why you need to be making 1,200 trades while serving in Congress. It creates conflicts of interest and destroys public trust. But Tommy doesn't care. He's made 1,222 trades, and right now, he's buying PayPal. Now, I actually own PayPal, so I'm biased here. But let me explain why I think it's interesting, regardless of what Tommy knows or doesn't know. PayPal is extremely popular in the value investing community, right? Now, the stock has been beaten down significantly from its highs, and people see opportunity. Here's what I like about PayPal. The company generated $5 billion in free cash flow last year. For a company people keep calling dying, that's pretty impressive. Let's look at their revenue growth. In 2019, they did $13 billion in revenue. 2020, $15.5 billion. 2021, $21 billion. 2022, $25 billion. 2023, $27 billion. 2024, $30 billion. Does that look like a dying company to you? Revenue is growing every single year. The narrative around PayPal is that they're losing users. And that's partly true. User growth has slowed. But here's what people miss. Transactions per user are increasing. I'd rather have fewer users who transact more frequently than tons of users who barely use the platform. Quality over quantity. PayPal also owns Venmo, which is one of the most popular payment apps among younger demographics. That's a massive asset that I think the market is undervaluing. When I look at PayPal's fundamentals, I see a company trading at a significant discount to its intrinsic value. Analysts expect earnings per share of $4.30 this year, growing to $8.85 over the next few years. That's substantial growth. When I run PayPal through my analysis with revenue growth assumptions of 4, 7, and 10%, profit margins of 12.5%, 15.5%, and 18.5%, and PE ratios of 13, 16, and 19, I get a fair value range of $55 to $70 on the low end, $160 to $200 on the high end, and $95 to $120 in the middle. PayPal is currently trading around $65. That means it's trading near the low end of my fair value range, which suggests upside potential. Is that why Tommy Tuberville is buying? Maybe. Or maybe he knows about upcoming fintech regulations that will benefit PayPal. Either way, I think the stock is reasonably valued here and offers solid upside if the company executes on its growth plan. Stock number 3 is Advanced Micro Devices, better known as AMD, being bought by Marjorie Taylor Greene. Marjorie is famous for her political positions, but less discussed is her stock trading activity. She's made 138 trades, which is actually modest compared to some of her colleagues. Her estimated net worth is $41 million. Pretty impressive for someone relatively young in her political career. Interestingly, she also invests heavily in treasury bills, which I actually agree with. I keep a significant portion of my cash in 90-day treasuries earning 5.4%. It's a safe, liquid place to park money while you wait for opportunities. But she's also buying AMD, which is interesting because AMD has been extremely volatile lately. The stock bottomed at $55 per share in October of 2022. It then rallied all the way to $227 in March of this year. But from that March peak to today, the stock has dropped 30% in less than 3 months. It's currently trading around $165. That's the kind of volatility that destroys portfolios if you're not careful. But it also creates opportunities if you know what you're doing. AMD sells for 11.8 times price to sales. That's significantly cheaper than NVIDIA, which trades at 45 times sales, but it's still expensive by traditional standards. The company has a gross margin of 47%, which is good, but the profit margin tells a different story. Last year, they did 4.9% net margin. 5-year average is 10%. Those are not tech company margins. Those are commodity semiconductor margins. Return on invested capital is also low, which suggests the business requires massive capital investment to grow, which limits shareholder returns. So why is AMD valued so highly? Because of the AI boom. Because everyone assumes AMD will capture market share from NVIDIA in the data center GPU market. But assumptions aren't guarantees. NVIDIA has a massive head start, better software ecosystem, and deeper relationships with major cloud providers. Can AMD compete? Absolutely. Will they? That's the billion-dollar question. Analysts are projecting earnings per share of $3.50 this year, growing to $10.89 in 4 years. That's about 3 times growth, which is aggressive. If they achieve that, the stock is reasonably valued at current prices. If they don't, it's significantly overvalued. When I run my numbers on AMD with revenue growth of 8, 12, and 16%, profit margins of 8, 15, and 22%, and PE ratios of 18, 21, and 24, I get a fair value range of $30 on the low end to $175 on the high end, with a middle estimate of $80. AMD is currently at $165. That suggests it's trading near the top of my fair value range, which means limited upside unless growth significantly exceeds expectations. So why is Marjorie Taylor Greene buying? Does she know something about upcoming chip legislation? About government contracts for AI infrastructure? Possibly. The CHIPS Act allocated billions for semiconductor manufacturing. Maybe she knows how that money will be distributed. Or maybe she's just buying the hype, but her timing will tell us a lot about whether she has an edge or not. Stock number 4 is Elf Beauty, being bought by Mark Wayne Mullen. Now, Mark Wayne is another interesting character. He has an estimated net worth of $64 million and has made 192 trades, making him one of the less active traders in this group. But here's what's interesting about Mark Wayne. He has incredible timing on specific trades. He sits on the Senate Environmental Services Committee. On February 7th, 2024, he bought Badger Meter, a company that makes water flow measurement devices. Shortly after he bought, the EPA passed mandatory requirements for utilities to upgrade to newer automated water systems. Badger Meter stock is up 40% since his purchase. Coincidence? Maybe. Or maybe he knew that EPA regulation was coming because he sits on the committee that oversees environmental policy. Now he's buying Elf Beauty, a cosmetics company. And I want to know what he knows. Elf Beauty has been an absolute monster stock. Over the past 5 years, the stock is up 1,700%. 1,700%. Year to date, it's up 35%. Over 6 months, it's up 59%. The company has a gross profit margin of 70%. 70%! That's phenomenal. That means for every dollar of product they sell, they keep 70 cents after cost of goods sold. But here's what's strange. Despite that massive gross margin, their net profit margin is much lower. They're probably spending heavily on marketing and advertising to build brand awareness. Elf makes cosmetics and accessories for women. Eyeliner, mascara, false eyelashes, lipstick, mass market beauty products. The company has a market cap of $11 billion with an enterprise value of $11.4 billion. That small difference indicates minimal net debt, which is good, but the valuation is astronomical. The stock trades at a PE ratio of 87 and a price to free cash flow ratio of 176. Even with aggressive growth assumptions, those multiples are extremely expensive. Analysts are projecting EPS growth from about $3 this year to over $4 in future years, with revenue growth rates of 81% this year declining to 27% and then lower in subsequent years. Can they sustain that growth? Maybe. The beauty industry is competitive, but Elf has positioned itself as a value brand with high quality. If they can maintain market share and expand distribution, the growth story could continue. But at current valuations, the stock is priced for absolute perfection. Any stumble in execution, any slowdown in growth, and this stock could get cut in half. So why is Mark Wayne Mullen buying? Does he know about upcoming cosmetics regulations, tariff changes that will benefit domestic manufacturers, FDA approvals for new product lines? I don't know, but his track record suggests he might know something the rest of us don't. And now, the moment you've all been waiting for. The greatest investor of our time, the queen of congressional stock trading, Nancy Pelosi. Warren Buffett, sit down. George Soros, step aside. Nancy Pelosi is the undisputed champion of stock market investing among elected officials. Her estimated net worth is $250 million. She's made 164 trades with an average volume of $125 million per trade. Interestingly, she hasn't been as active recently. Maybe she's getting more cautious as scrutiny on congressional trading increases. But her latest buy is Palo Alto Networks, a cybersecurity company. Let me break down why this is interesting. Palo Alto Networks generates $3 billion in free cash flow compared to $2.5 billion in net income. That means they're converting earnings to cash efficiently, which is a great sign. The company has a market cap of $109 billion and an enterprise value of $120 billion. That $12 billion difference represents their net debt, which is easily manageable given their cash flow. Here's what's really interesting. Their 5-year net income is $320 million, but their 5-year free cash flow is $1.9 billion. That massive difference suggests there was some non-cash write-off or charge that depressed net income but didn't affect actual cash generation. When evaluating companies, I always focus more on free cash flow than net income for exactly this reason. Free cash flow tells you what's really happening with the cash in the business. Palo Alto has a gross margin of 74% and a net margin of 31%. Those are outstanding margins for a technology company. Revenue growth has been exceptional. They've grown from $8 billion to over $15 billion projected in the next few years. That's almost doubling revenue in 5 years. Analysts project earnings per share growing from $5.68 this year to $14.30 by 2028. That's 150% growth over 4 years. If they hit those numbers, the current valuation starts to make sense. If they miss, the stock could be in trouble. When I run Palo Alto through my analysis with revenue growth of 10 and 15%, profit margins of 10, 20, and 30%, free cash flow margins of 30, 35, and 40%, and PE ratios of 15, 18, and 21, I get a fair value range of $117 on the low end to $420 on the high end, with a middle estimate of $224. Palo Alto is currently trading around $230, which puts it right around my middle fair value estimate. So why is Nancy buying? Does she know about upcoming cybersecurity legislation? Government contracts for federal cybersecurity infrastructure? Regulations that will require companies to increase cybersecurity spending? Given her position and influence, it's entirely possible she has insight into policy changes that will benefit cybersecurity companies. Cybersecurity is one of the few industries where government spending is virtually guaranteed to increase, regardless of which party is in power. It's a bipartisan priority. If you're looking for a sector with strong tailwinds and government support, cybersecurity is hard to beat. Now, let me step back and talk about what all of this means. Congressional stock trading is fundamentally unfair. These people have access to information that creates an asymmetric advantage over regular investors. They know about legislation before it's public. They know about regulatory changes before they're announced. They know about government contracts before they're awarded. And they're using that information to make trades that generate massive returns. The Stock Act, passed in 2012, was supposed to prevent insider trading by members of Congress. It requires them to disclose trades within 45 days and prohibits them from trading on non-public information. But enforcement is almost non-existent. The penalties for violations are minimal, usually just a few $100s. And proving that someone traded on inside information is nearly impossible. So the trading continues, and the fortunes grow. Now, should you follow their trades? That's a complicated question. On one hand, they clearly have an edge. When Josh Gottheimer sells a bank stock one day before it collapses, that's not luck, that's information. On the other hand, by the time you see their trades disclosed, it might be too late. They're required to disclose within 45 days, which means the stock could have already moved significantly. Also, not all congressional trades are based on inside information. Some are just following the hype like everyone else. Some are making emotional decisions. Some are poorly timed. You need to evaluate each trade independently and do your own analysis. Here's my approach. When I see a congressional member make a trade, especially someone with a track record like Gottheimer or Pelosi, I pay attention, but I don't blindly follow. Instead, I use it as a signal to do deeper research. Why might this stock be attractive? What fundamental factors support the thesis? What are the risks? What's a reasonable valuation? If my analysis confirms that the stock is undervalued or has strong catalysts, then I might take a position. But I never buy just because a member of Congress bought. I buy because the fundamentals support it and the congressional trade gives me additional conviction. Let me give you some practical advice for analyzing stocks, whether they're congressional picks or not. First, always start with the fundamentals. Revenue growth, profit margins, cash flow generation, balance sheet strength. These are the building blocks of any investment thesis. Second, understand the industry dynamics. Is this a growing industry or a declining one? What are the competitive advantages? Who are the major competitors? Third, evaluate the valuation. Is the stock cheap, fairly valued, or expensive relative to its growth prospects? Use multiple valuation methods: PE ratio, price to sales, price to free cash flow, discounted cash flow. Fourth, consider the catalysts. What could drive the stock higher? New products, market expansion, regulatory changes, industry consolidation. Fifth, assess the risks. What could go wrong? Competition, regulatory headwinds, execution failures, macroeconomic factors. Only after you've done this analysis should you consider whether insider or congressional trading activity adds to your conviction. Let me also address the elephant in the room. Should congressional stock trading be banned? In my opinion, absolutely yes. There's no reason members of Congress need to actively trade individual stocks. They can put their investments in blind trusts managed by independent advisors. They can invest in broad index funds. They can avoid the entire conflict of interest. The argument that banning stock trading would discourage people from serving in Congress is ridiculous. If you're only willing to serve your country if you can trade stocks with inside information, then you shouldn't be in Congress in the first place. Public service should be about serving the public, not enriching yourself through information asymmetry. But until the laws change, and I'm not holding my breath, congressional trading will continue, and we might as well pay attention to what they're doing. So let's recap the 5 stocks we discussed today. Tesla, being bought by Josh Gottheimer, overvalued by traditional metrics, but possibly positioned to benefit from pro-EV policies. PayPal, being bought by Tommy Tuberville, trading near fair value with solid growth prospects, and underappreciated assets like Venmo. AMD, being bought by Marjorie Taylor Greene. Expensive valuation, but positioned in the AI chip market with potential to gain share from NVIDIA. Elf Beauty, being bought by Markwayne Mullin. Phenomenal growth story, but extremely expensive valuation that prices in perfection. Palo Alto Networks, being bought by Nancy Pelosi. Strong fundamentals in a sector with government tailwinds, trading near fair value. Out of these 5, which would I personally invest in? PayPal and possibly Palo Alto. PayPal because I think the market is undervaluing its assets and growth potential, and the valuation is reasonable. Palo Alto because cybersecurity is a sector with strong structural tailwinds, and the company has proven execution. I'm skeptical of Tesla at current valuations unless you have very aggressive growth assumptions. I think AMD is priced too high relative to execution risk. And Elf Beauty, while impressive, is trading at multiples that make me nervous. But that's just my analysis. You need to do your own research and make your own decisions. The key takeaway is this: Congressional trading activity can be a useful signal, but it's not a substitute for fundamental analysis. Use it as a starting point for research, not as a buy signal by itself. Do the work, understand the business, evaluate the valuation, assess the risks, and never, ever invest money you can't afford to lose based solely on what some politician is doing with their portfolio. Because while they might have an information edge, they're also human. They make mistakes, they get emotional, they follow hype. Your job as an investor is to be smarter than that, to make decisions based on facts, not tips, based on analysis, not rumors. Congressional trading is fascinating to study, but your investment success depends on your own discipline, knowledge, and decision-making.